Crazy stuff today. The S&P 500, we are currently down at this moment just about 0.3%. But what's so big about this day is the 52-week range. The 52-week range was hit today. 360.88. The days range, 360.88. And now this is making the S&P 500 have the last 9 out of 11 days be in the red. We have consistently been falling day after day after day. I mean, when you take a look at this daily chart, we could see that the S&P 500 has been getting absolutely torched. And the whole reason behind this all actually started back on August 26th when Jerome Powell came from the Jackson Hole, Wyoming meeting, and he said, we are going to use all of our tools to be more aggressive in fighting inflation. From there, the market immediately got a lot more negative. We started seeing fear and greed start taking on over. We started seeing traders start getting nervous about the upcoming interest rates. Then we moved over into our interest rates this September. We are seeing that the Federal Reserve has raised interest rates 0.75%. From there, the market has dropped dramatically. So today is a very big and very important day. Because as we hit brand new 52-week lows, I know there's two things that are going through your head at this moment. Number one, is it time for a dip buy? And number two, how much lower are we going to go? Those are the big questions that you're probably asking yourself at this moment. So let's start with number one. Is it time to start getting involved on a dip buy? If you buy right now, would this be a bad entry whatsoever at all? And I'm going to be honest with you, and I'm going to be straight up with you. If you bought right now, or if you're going to buy today, tomorrow, it is not a bad entry whatsoever. And anyone who puts you down for saying, oh, well, it might go lower, they have a point, it might go lower. But no one's going to criticize you in any sort of way while buying the S&P 500 when it's down almost 25% on the year. Let's go ahead and check this on out. If we go over towards the S&P 500, and a very just simple thing is just go to google.com, type in the S&P 500, and what do we have? Year to date. Year to date, we are down 23.91%. Let me ask you guys a question here. Think of your favorite store. Your favorite store could be, let's say, I don't know, PacSun. Your favorite store could be GNC, where you go get your protein. Your favorite store could be Kohl's. You want to go ahead and buy some t-shirts. Think about your favorite store, whatever it may be. Now imagine if your favorite store was having a 25% discount on all items. Wouldn't you want to take advantage of that? Absolutely. Now, would it be cooler if they had a 30% discount or a 35% discount? Absolutely. But the thing is, you are getting a discount at this moment. And if you start buying in right now at the price of $360, $370, you are getting a price that many traders wish they had. Because you know why? It has been taking almost 10 months to get to where we're at this moment. We have been seeing traders that have been buying in and losing and buying in and losing and buying in and losing and buying in and losing. And now another question probably arises. Well, it says, Deck, if I buy right now at 360, how am I know that I'm not going to get caught up in the mix? Caught up in the mix as being a trader that buys and loses. Because what if I bought at 440? Or maybe if I bought at 400? Or maybe bought at again 380? And now you're telling me to buy 360? You know, it's very tough to want to go ahead and get in right now, because what if it just keeps going lower and lower and lower? And that's the problem with stock trading. That's the problem with investing, where we always ask ourselves and think things are going to be getting lower. And by the time that we are not in, by the time we realize that we have already seen the bounce, it's usually too late. Because be honest with yourself here. Did you buy in when it came down to 360 the first time? And were you kicking yourself when it got back up to 400? Were you really angry with yourself when it was at 418? Were you super upset with yourself when it was at 430 and you said, man, oh man, I can't believe I missed the dip buy? Do you want to go through round two of possibly missing the dip buy? So this is all the way back down to 360 at this time. We are having at this moment what we like to call a double bottom. Why is it called a double bottom? Very simple, very easy. It's because it's hitting the bottom price 2 times in a row. So what would I do here? I'm again sitting here and telling that I think it's a great opportunity to get involved in this market. All right, Dex, so let's see your P&L. Let's see, what price you're in. And I'm going to tell you right now, I'm not in yet. So how are you going to tell us to go ahead and buy, but you're not in at this moment. Well, I'm going to explain exactly what I want so everyone can see my full transparency. I'm telling you right now, if you are looking for a trade, as long as we stay above the price of 350 on the S&P 500, or 360, excuse me, I think we are absolutely good to go. But once we start going down to 359, once we start going down to 358, 357, that's where things are going to start dropping even harder. Yes, I think we are going to go lower. Yes, I am not in at this time. But if someone said to me, hey, the stock market's down 24% at this time. We're getting a double bottom. The S&P 500 is oversold on the RSI. There's a lot of opportunity to go on up. I wouldn't be able to criticize you in any sort of way for wanting to jump in at this moment. And if you have a stop loss at 359, what is the issue? What's the issue of you saying, hey, I want to get in right now at 362. I have a hard stop loss at 359. When in doubt, I lose $1,000. But if the stock does bounce, or if the markets do start bouncing back on up, I could potentially make $10,000, $20,000, $50,000. The thing is, on the S&P 500, you are correct that we could go lower. But what I want you to also understand is we may not go lower. And there is so much more reward than we have risk, I believe, at this moment. And you might say, well, no, it could go a lot lower. We have a lot of risk. Well, not if you have a stop loss. If you have a stop loss of $3 on the S&P 500, you have a $3 risk with, again, massive potential to be able to go on up. So when we think about this, and you might be asking yourself, all right, Deck, well, what's your game plan? What are you thinking at this moment? Well, my game plan at this time, I feel like I'm coming out a little aggressive today, if I may ask. All right, I'm gonna tone it back a little bit. I feel like I'm yelling. So what we have at this time, what I do want to bring up is average recession market drops. And again, team, I'm just so passionate about what I talk about because I want everyone to be successful. I truly do. I'm not saying this to tell you, again, maybe not what you want to hear. I'm telling you this because this is what I believe is going to happen. I've been extremely successful in the stock market. I've been able to do this as a full-time trader for the past 8 years. I, again, speak and I want you to have success. And I don't want someone to just watch a random YouTube video and not be able to be successful or, again, follow the wrong guidelines. I want to show you everything from different perspectives so you guys can formulate your own game plan. Now, this is my game plan. My game plan is, among the bear markets since 1946, the average decline with a recession was 35.8% versus 27.9% on average without a recession. Their data showed. At its low point in mid-June, the S&P 500 has dropped 23.6% from its high. It since has rebounded over 10%, and that was in July of 28th, 2022. So let's think about this. Let's take this on what we have learned. We have learned when there is a recession, we fall 35.8%. And this has been over the past 80 years. When there is not a recession, we fall around 28% on average. So we already looked at the market has fallen about 23.8% so far. If we are saying to ourselves, there's no recession just yet, that means the average, let's just round up to 28%. If there is a recession, it's going to be around 35%. So if we break this on down and we ask ourselves, what would those numbers calculate out to? A 28% drop is going to be bringing us down towards right around that 350 mark. And if we want to go down towards around a 33% drop, it's actually going to be dropping us all the way down towards around 338, 339. So the S&P 500, the safest entries I can think of is be going next to the averages. The average pullback, the average recession, the average drop. We take information from the last century, let's say the last 100 years, and we say, all right, if we jump in at the average, sure, there may be a little bit more wiggle room, right? Or there could be, we jump at the average and we're going to have the best opportunity to make money. There has never been a recession. There has never been a correction. There has never been a depression that the stock market has not ever recovered from. And you know what I hear all the time? I hear it on, again, TikTok. I hear it on YouTube. I hear it on, whatever. But this time's different. Oh, Deck, the stock market's going to drop 80%. Why? Because this time's different. We've never had inflation. We've never had, again, this. We never had that. This time's different. Well, team, you know what? In 2008, we never had, again, a housing market crash like that. And in 2000, guess what? We've never had, again, a dot-com bubble. And again, in the 1920s, we never had a Great Depression before. And we never had every single recession Every single, again, correction we have is usually because it's something that is unknown. It's something that we're not used to. That it's because new technology develops as we go, and we can only take it as we get it. And that's why every single one is, well, we never had it before. Now, as being as intelligent as we are a lot more intelligent. We are a lot more advanced. We have much more technology. We have a lot more help as, of course, time goes by. Do I ever think the stock market is going to fall like it did in the 1920s? I'm going to say, no, I don't think it will. And do I think it's going to fall as hard as it did in 2008 when we fell over 40% on the market? No, I don't think it ever will. I do think, though, we could fall 29, 30%. I do think we could get to that average around 33, 35%. I do think that's possible, but I don't think we're going to drop 50%. This is not the cryptocurrency world. This is not, again, seeing Bitcoin fall 77% and people saying, oh, it's going to go lower. This is the stock market that has been over time a place where you can invest and you can see profits. We can already tell here, this is showing us, and let's just even extend this even more. This is showing us a chart from 2009, guys. 2009, the last 13 years of the market. What has the last 13 years of the market done? It has gone up. We have seen it gone up, and there has been pullbacks back in 2011, and there have been drops in 2018, and there was, again, a serious, I can't even say the word because they kind of block it out. You guys know that what happened over again back in 2020 right here, which led to a very big drop. And you know what? We climbed and climbed and climbed, and we're getting a very big drop right now because of inflation, because of supply chain, because of interest rates, because of everything that we had to do to adjust during that time. But when we take a look over on this chart, what can we realize? Look how great this bounce play was back in 2018 off the 50-day moving average in 2018. And take a look off this bounce play that we had back in 2020. And we're coming up towards this bounce play opportunity at around that 350 mark. And putting us right around 350 would put us down around 28%, which is also the average without having any sort of recession. Now, that's another kind of confrontational aspect right now. And I don't want to make it political in any sort of way, but it seems like, at least in politics or in the government, some people are arguing we're not in a recession at the moment. Some people are arguing we are in a recession at the moment. The recession is defined as back-to-back quarters of negative GDP growth. We have had that, but this has been a little bit of a different recession as well. We haven't seen as many job layoffs, right? And that's kind of been like the big talk of the town. Oh, we're in a recession, back-to-back negative GDP growth. No, but again, we're not really seeing anyone fired. We're not seeing anyone lose their job. We're actually, again, people are actually getting paid more because, of course, inflation's been going on. So it has been a little bit weird. So we just have to take the stats as we take them or as we see them. And what that means is, hey, if we don't have a recession, the average bear market is going to be around a 28% pullback. If we do have a recession, the average, again, bear market is going to be around a 35 to 36% pullback. Now, as the S&P 500, we take a look at the chart, the first main line of support coming on up is going to be around this 350 mark. So that's what I want to be looking at with my absolute bottom all the way on down towards around that 338 mark. So what could I do to be able to have the best entry possible? I plan on putting roughly about $750,000 into the S&P 500 in the near future. But I want to be able to break up that $750,000 and put it in when we hit 28%, when we hit around 33%, and if we get up towards around that 35, 36%. This is called scaling in and averaging in, so I'm going to have the best opportunity of having the best average. Now, why am I picking the S&P 500? Well, the S&P 500 is an index fund. An index is a basket of stocks. Imagine a basket in my hands, and I take Tesla, whoop, throw it in there, and I take Apple, and I throw it in there. And I take Microsoft and throw it in there. And I take Google and throw it in there. And I take Amazon and throw it in there. And what we have here is, even if one or two maybe have a red day, the other ones are going to be green, which is going to help me stabilize at all times and be able to produce more than I lose. So essentially the S&P 500 throughout the years wins. And the reason why it wins so much is because we take the winners and keep those, and we get the losers out of there. So we're constantly, again, having winners in this basket. The S&P 500, why people don't like it a lot of times is because it's some of the slowest producing. You are correct. But over time, it is going to compound and keep building and building and building. Just imagine I wish I got filled in 2012. And even if, going from 2012, imagine if someone told you right now, they said, oh, the S&P 500, what price are you in at? And then someone says, oh, I'm in at 126 right now. 126? When did you get in? 2012. Yeah, I know, I'm up like $250 per share. That's where, again, retirement comes from. This is, how people make big money. And it's not just the S&P 500. We also have Vanguard. Vanguard, this is essentially going to be the same exact thing as the S&P 500. But if you ever set up a retirement fund through Vanguard, this is, again, their index, VOO, which is, again, a basket of the best plays. That's why it looks so similar to the S&P 500. So I'm a person that just wants to go off of facts. I don't want to go off of, oh, I got this strong feeling. This strong feeling doesn't mean anything to me, right? You ever go to a casino before and you ever play blackjack and it'll be like, let's say 2 numbers, like it'll be like a 15 showing. And you say hit and it's like a 16 showing. And it's like, ooh, I don't know. I got a good feeling. I want to hit one more time. I got a good feeling about this one. Hit. And all of a sudden like a king or a jack or something comes on up and you're like, Because again, at the end of the day, your feeling means nothing. Your feeling means absolutely nothing. And in the stock market, guess what? It means absolutely nothing. And I know, again, you want to believe that you have some sort of superpowers or something along those lines where you're saying, I don't know, Deck, this, random little penny stock right here. I'm just going to type in some random letters, CCIX. I got a good feeling about this one. Team, it's not about feelings. It's about chart setups. It's about facts. It's about businesses. It's about the economy. It's about global markets. Not, again, your individual feelings randomly trying to hit a home run grand slam pick. So the thing that I want to do is base it off of the past century. 27%, 28% pullback without a recession, 35 to 36% pullback with a recession. S&P 500, that's going to bring us down towards around the 350 mark. That's going to be the first area that we want to start getting involved in, and we want to load up as much as we can if we drop on down towards the 333s. As we already talked about, I do think a great entry is anywhere near the low 360s because, as we stated, we do have an amazing double bottom at 360s. This would be more as a swing trade, but you know what? As long as it holds above 360s, keep on holding. Have a hard stop at 359. If it goes down to 359, get out because we know the destruction that could be coming. But you know what? If a double bottom happens to hit right here, then you got no problem whatsoever. You have so much more reward than risk, and that's what trading's all about. If you bought, let's say last year in December or in January, right at the top, you had a lot more risk than reward. And that's because the market had one of its best years ever. It was up over 20%. Our average year that we usually have is anywhere between like 10, 11, 13%. That's what, on average, what we usually see in the market. Last year, the S&P 500, we're up over 25% on the year. And that's incredible. But we could probably imagine things are going to slow down a little bit. Now, what also gets me very excited, as we've talked about before in the past, is since 2000, since, again, the dot-com bubble. The dot-com bubble was the last time it was kind of different, where we had red year, then we had green. But since then, every single red year that we have had in the stock market was followed by a green year with at least 20% gains or higher. So what does that tell me right now about the S&P 500? Well, we only got 3 months left in this year. We got October, we got November, we got December. If we finish off with a 27% drop, a 30% drop, that's going to be telling us that we have massive opportunity to be able to gain back up 20% the following year. You know what also we're doing coming up in January? We're slowing down or stopping interest rates. I believe we have interest rates coming up in November, and we have interest rates coming up in December. And then as we move into 2023, I believe we have one more interest rate that we got to be watching. But once interest rates basically are stopped being hiked on up, there's going to be a lot of optimism in the stock market. We're going to see a lot more confidence in the stock market. And that's what's so important about stock trading. Not only do we have to take all of this into effect that I already talked about, but we also need to understand investor sentiment. And investor sentiment is essentially how are traders looking and perceiving the stock market. So what do we have here? We have at this time, as the market is at the lowest points, we have at this time the fear and greed index. We have extreme fear in the markets. Extreme fear leads to selling because it leads to people holding their money. When you're scared and you're uncertain, you don't usually put your money out there. Let's think about it like this. Imagine some random guy knocks on your door. He's wearing a big trench coat, sunglasses, scary face, and he looks at you and he says, hey, give me $10,000 and I'm going to turn that into $1 million for you, and gives you a little devious smile. Would you give him $10,000? You would probably say no. Maybe again, go and lock the door, call the police. And you know why? Because you're scared, because you're uncertain, because you're fearful. You don't know who that is. That guy was weird. That guy was creepy. I'm not giving you any money whatsoever. But what if, let's say a man shows up in a Ferrari, in a Lamborghini, comes out in a nice suit, and he says, hey, I'm friends with your uncle. Oh, Uncle Ted, I love Uncle Ted. Yep, here's a picture of me, Uncle Ted. Hey, you know what? I can I could do this with your money. You would have a lot more confidence. You would say, wow, that's awesome. Yeah, you do money for Uncle Ted. I want to do this. And now again, you're more happy, you're more confident. And you know what? That brings in the greed. The more confident you are as a trader, the more happy you are as a trader, the more, again, money crazy you are as a trader. That's going to lead towards more buying. That's going to lead towards you putting more money in the market. That's going to lead towards more emotion, which leads towards not only you buying, but other people buying, and groups of people buying, and Wall Street buying. And the more confidence and happiness there is in the market, the more crazy spikes in activity there is. Think about last year. Last year, we saw the NFT market. We saw the cryptocurrency market. We saw the S&P, the stock market, spike up towards crazy highs. Bitcoin going bananas. People spending $3 million on pictures of kittens. We have, again, the market's going crazy. Whatever you buy, you win money on. And that's why everyone was just buying things nonstop. Not only that, people were buying houses nonstop. People were buying cars nonstop. Because why not? Everyone was making money on it. If you bought it, you hold it for a week, you can sell it for more profit. Everyone was going crazy buying things. But not right now. Right now, people are, again, taking their money and they're taking their wallets and saying, no, get away from me. No, I don't have any change. Right? That's what people are doing at this time. So you could see how it changes and how it's different. And as long as this meter is on fear, extreme fear, there's going to be people that are saying, hey, you know what? I don't want to put my money into the market right now. And that's going to lead towards more fading, more dropping, and leading towards this market getting weaker at this time. So what we, again, essentially are coming down to is we do have a double bottom, which is absolutely fantastic, and we could get a bounce play. Hard stop loss at 359, and if that starts getting cracked, we want to be looking for our first entries all the way back on down towards around that 348 mark. Okay, so let's get ready to rock and roll on that. Wanted to do a full breakdown on the S&P 500 at its current levels to make sure that you're all set, ready to go. Last but not least, what I do want to talk about as well is just go over to stockcharts.com, and something that I did earlier to help me make my $500 on the day is look at the RSI. The RSI, there is going to be days of weakness and days of strength coming on this RSI. The RSI is fantastic. You know why? Because whenever the RSI is considered oversold, which means whenever the RSI is near the price of 30, guess what happens? Whenever we have it near 30, just drag this on down, you can see the market rises. And now we have it all the way on down towards around a 30. There's a chance for this double bottom that you get a nice 3-4 day rally. Just like when you're considered overbought, you get a drop. On the RSI, anything that is under a 30 or near a 30 is oversold. Anything that is near a 70 or above a 70 is going to be overbought. When you're overbought, you tend to drop. When you're oversold, you tend to rise. Not on penny stocks as much, but definitely on blue chips. So make sure that everyone is aware of that and always look at your RSI. Take it, crush it, let's get after it, and want to make sure that everyone is all prepared for the future, got your numbers right, and making sure that you guys are going ahead and making some money in the near future. Let's get ready to rock and roll. Let's get ready to get set. And of course, watch your eyes over on the S&P 500 over the next few days, baby.